Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Welcome to the show. Thanks for tuning in. Appreciate you joining us on the Smart Property Investment Show. Today, got a couple of guests in. Regular commentator and mortgage and real estate guru.
I wouldn't call myself a guru.
James Mitchell, who heads up editorial here at Sterling Publishing across all of our real estate and mortgage products. James, mate, thanks for coming along.
Cheers, Phil.
And I have Michael Shah here as well. So you might remember Michael from a podcast we did a couple of months ago, post-budget, where we had a good conversation around what it all means. So during that week, the budget was handed down. There was an interest rate cut of 1.75%, the first move in quite some time. Banks announced a whole bunch of profit announcements, most of them looking good. By memory, ANZ's was down a little bit. And importantly, with the budget announcement, we all found out that negative gearing was safe and no one's going to touch it, which made everyone very happy, particularly property investors like Michael. Michael, thanks for coming, mate.
Good to be here again.
Last time we had a chat, it was more about you in your life now as a mortgage broker, which you sort of evolved to after purchasing lots of property and getting the property bug and immersing yourself in everything and quitting your corporate job, which was really good. Today, mate, what we want to have a chat to you about is your property portfolio. I've got some notes here. It's impressive what you've achieved. Can you just talk us through it? So when did you start? Where are you now? And what's your portfolio worth?
So I started when I was quite young. I bought my first property around 22, 23. And at that time, I absolutely had no idea. So I basically walked up to a showroom of a new development in Epping, in Sydney. This was before the trains were in Epping, in terms of going across to Chatswood. And I bought a studio, less than 50 square metres off the plan, for $340,000. And I'm sure people that listen to your podcast know that it's a bit of a no-no. So, interestingly enough, so I bought it at $340,000. This would have been in 2004. And in 2014, so 10 years later, I had it revalued. And it went from $340,000 to $400,000.
Wow, you've killed it.
Killed it, yeah. So when they say property prices double in 10 years, let me tell you, it's not all properties.
I don't want to give you a hard time about this, but I'm going to. Why did you buy it? Like, did someone tell you to barbecue? Oh, look, I hear there's these properties.
Basically, yeah.
Yeah.
I mean, the funny thing was, I think we were all a bunch of 20-year-olds and we went to a poker night and one of the mates just told me, hey, there's this new development opposite the station, reckons it'll go really well. And I'm like, hey,
that's Epping Station, right?
Yeah, Epping Station.
What's the nightclub? What's the pub there? I used to go there when I was at university.
The pub has a good nightlife there, and also there's a very good kebab store that's open 24/7. So,
well, here, the kebab index says that when kebab shops start opening it up, property prices are going to soar.
That's good infrastructure.
Yeah.
So you wouldn't do that again, right?
No, absolutely not. And even to this day, it's negatively geared. So interestingly enough, when we first bought it, the strata was $500 a quarter, which, you think, all right, for a studio, it's fairly manageable. Shortly after that, it went to over $1,000.
Really?
Yeah.
Ouch. So any of your mates buy there as well?
No, it was just me.
Yeah.
So, the saving grace has been there's been a good tenant in there. So I've just held on to it and it's had good negative gearing from the depreciation. But look, if I had my time again, definitely wouldn't do that.
So how old are you?
I'm 31.
You're 31. Okay. So you're still relatively young bloke. You've been at this for how long now?
That was in 2004. So that was my first purchase. So that would be about 12 years. But in my early days, I didn't do anything. So I bought that one and that one set me back a long time. And I'm like, property investing sucks. I'm just hemorrhaging in terms of the repayments and it hasn't gone up in value. So definitely that didn't put me into property investing. I picked up another property in 2010. So it was almost 6 years later. And once again, it was almost on a whim. But this time, as opposed to that, I actually did quite well.
Was that in Sydney as well?
Yeah, it is in Sydney, in a suburb called Macquarie Park. And the common thread between all of this is I grew up in Eastwood. So they say a lot of investors look at the surrounding suburbs. I was definitely that. So I bought one in Epping and one in Macquarie Park. The difference with Macquarie Park was in terms of, if you look at it, the fundamentals, it was all there. It was 5 minutes walk to the university, had a new train line going into Macquarie Park, and also you've got a massive shopping centre there. And I bought an older style brick walk-up, only 3 levels, picked it up for $420,000 in 2010. And now, there's comparables going between 700 to 750.
Much better. Who rents it? Students, I imagine?
Students,
From
students.
Macquarie Uni.
That's
Yeah.
right. And it's never vacant. I mean, there's a little bit over the Christmas period when students go overseas. But I mean, as an investment property, that probably is, I mean, even looking back, I didn't do too much about it, but that's probably the one that really set me up.
Your sort of values or morals or goals around property, how much do you think of that is associated with, you know, influences in your life like family or friends and stuff? Is it you just gone, I only get into property, or is it something that your family's done, or what's the story?
That's a really good question. I think growing up, it's always something that has been educated in terms of getting into property investing. But the methods that you invest in property is very, very different. I mean, coming from a Chinese background, we're taught, you know, loan is bad, pay it down as soon as you can. And that's what my parents essentially did. They bought a place and they spent their lifetime paying it off. So you are told from my parents to, you know, invest in property, but the methods that they did it was a little bit different. So always in the back of my mind, there was this idea of, okay, if you had savings, go and invest it. But then towards after when I really got into property investing, the methods that you did it was very, very different.
What's the value of your 14 property portfolio now?
I know that when I looked at it last year, it was about a little bit over 4 million. At the moment, it's probably a little bit more than that.
So 4+ million, you must know how much debt you've got on it.
Yeah, around about 3.3 mil.
3.3?
Yeah.
Okay, so you got about 700K in equity in it. What do your parents think about you carrying $3.3 million worth of debt?
I think
where do you live though? Do you live do you rent?
Yeah, so at the
rent
moment
it?
I'm based on the Gold Coast and I rent just Airbnb.
Nice.
It's actually phenomenal. For $30 a night, it's, you know, really, really
So you
good.
just go from place to place and
Yeah,
and
well,
do
I
whatever.
mean, I was going from place to place until I found this place, and it is just amazing.
It's
I
$30
mean,
a night.
yeah, for the host, I mean, he is so good there. He's in his 80s, and he's a real inspiration. So if he's listening to this podcast, yep, hi, America.
Mate, I hear, mate, it's very popular in the retirement villages, this podcast. So you're paying
$30 a night.
$30
yeah.
a night, right?
Yep.
Okay, so, and you got $3.3 million worth of debt.
Debt, yep.
Do your parents think you're mad? Do they get it?
Yeah, and you know, like, I mean, most of my friends when I first started just thought, you know, I was creating another financial bubble that the US went through back here. They were like, what the hell are you doing? I mean, that's just absurd. And I would say that, you know, if you'd spoken to me 3 years ago and said, you know, 3 years later, you'll have all that debt against your name, I'd be like, go away, that's crazy stuff.
Yeah.
But I think that as it grows and as your portfolio matures and you see the cash flow coming in, then it's a little bit easier to stomach. I mean, even after all the expenses, I still net between 30 to 40K in terms of rental income. So if my loan accounts are going up and they're not going down, helped by the last interest rate drop. So, you know, that definitely makes it a little bit easier to stomach.
So you canned your day job and corporate
Yep.
life. You're now a mortgage broker, and
Yep.
knowing how mortgage broking work, it generally takes a little while to get money starting
That's
coming
right.
in. Your mortgage business now, that's generating you an income, a salary. Is that giving you enough money to be able to go to the bank and secure financing?
So with that, a lot of the banks, they either want 1 year worth of tax return or 2 years. So I'm closing in on the 1 year. So once comes July, then we'll definitely look at the options.
And you're going to
then.
ramp up again, start
That's
buying
right,
and stuff.
yeah. So I want to refinance, top up, and then get all the funds out and then start to acquire more properties.
And do you have any concerns at the moment? I'm looking at our portfolio, and we've got quite a lot of equity in there. We haven't bought anything for about a year, December 2014, so it's about a year and 6 months nearly. And look at the market, and you know, some sort of headwinds coming out. You know, confidence around the economy. We're going down a very interesting path right now of shifting from a resources-oriented economy into a ideas and innovation economy. And you know, you just open a newspaper, you can read all about it. But I don't know how confident I am right now in the ongoing stability or direction. You know, things are going to be okay, but you know, but I'm sort of torn with: do I refinance now and cash up and start buying, or do I just sit there and go, look, I'm just going to sit and wait and watch and see what happens? You personally, if you could get the financing now, would you be refinancing your properties and buying hard?
Yeah, I would be. And I think it all depends on your goals. I think that if, you know, fast forward a couple of more properties and it's attainable to the goals that I've set for myself, then yeah, I probably wouldn't be leveraging up anymore. Then you'll go into consolidation phase. So I think it's different for everyone.
What's your end goal?
It constantly evolves. At the moment, in terms of an end financial goal, I would say, you know, passive income, probably around about $1 million. You know, that would be good. So, I mean,
That'd be good. What, $1 million a year would be good.
That's an income of $1 million.
Yeah, I mean, that's
enough.
something. And
That's the goal.
that's a long-term goal. At the moment, in terms of short-term goals, having around mortgage broking goals and so on and so
Yeah.
forth. So it constantly evolves.
How many properties do you need to get $1 million? I'm sure you've done the numbers.
It'll be a
Where's
lot,
your spreadsheet?
yeah.
But-
Yeah, honestly, I haven't even worked out how many because that's a long-term goal. That's, something to work far towards. But, something to strive for.
Yeah.
And, it won't just all be properties at that point. You also have shares coming into
Yep.
it through the mortgage broking business and it will
Yep.
be all-encompassing.
So let's just do a real quick blitz look at your portfolio. So there's 14 properties. First one, off the plan apartment in Epping.
Terrible.
Not good.
Yep.
Second one, not so bad, Macquarie Park. Number 3, 4, 5, 6, are they all in Sydney?
No, so at that point was when I came across Summersoft, when I came across, other property investors that were doing it very, very savvy. And that's when I kind of really got into it. And at that time, I was just buying renovators. So I would buy properties that needed quite a bit of work, improve the value, go to the bank to get them revalued, put out the equity and go again. So number 3 and 4 was actually in Newcastle. And at that time, it was around about 2014. And I remember looking in many parts of Sydney because at that point, if you told me to buy interstate, I would have told you to go away. That's crazy stuff. But from my own perspective, I felt Sydney had moved quite a bit already. In hindsight, I would have done much better if I bought in Sydney. I still remember going to actually an auction in Mount Druitt. It was a bank mortgagee. I'd done the B&P on the auction, so I was actually quite
B&P,
sad.
Building and Pest Inspection.
The building and pest.
Yeah.
And the house sold for $238,000. And I thought that was too expensive. I
Yeah.
didn't put my hand up. That property today, anywhere between $350 to $400. So even at that point, because it had gone up $30,000 compared to the previous month of bank mortgagee auctions in Mount Druitt, I'm like, this is too much for me. So I looked at historical data, what happened in the past cycles. And usually when Sydney did well, the satellite cities also did quite well. Areas like Central Coast, Wollongong, and also Newcastle. So I would spend one weekend in Wollongong, one weekend up in Newcastle and just looking for deals. And I came across 2 really, really good buys in Newcastle and I did renovations on those. And we ended up increasing the value by quite a bit. So, rough numbers wise, I picked up a 2-bedroom house for $195,000.
Where in Newcastle was that?
That was in Gateshead.
Okay.
And renovated for about $25K. And the bank's revalued at $305, and that was in 3 months worth of work. Another one was in Cardiff, $225, renovation about $38-40K.
That's pretty much a full reno. Like
Kitchen,
bathroom,
yeah, it was a big reno,
flooring,
basically
stuff.
interior.
Yeah.
And that one was revalued at $330. So I did those, pulled them those out. Also did another one quite far away near Coffs Harbour in a country town called Nambucca Heads.
I know Nambucca.
Yeah. Beautiful.
Not much happens up there.
No. I mean, if I had my time again, I probably wouldn't have got that one too. So it just shows that as you evolve as an investor, there's a lot of things that you wouldn't do. That kind of did its job. We pulled out a little bit of equity, not so much from that one. And then that was 3, 4, and 5. And then after that, I still wanted to buy in those areas, but they had really started to move and I couldn't pick up the same deals buying in the low 200s compared to what I was doing 6-12 months ago. And at that time, there was a little bit of talk about Brisbane, and that's when then I started moving towards Brisbane.
So when was that?
This would have been in 2014.
Okay.
All of my Brisbane purchases were in 2014. Yeah.
We got a lot in 2014 up there as well.
Looking at the grand scheme of things in Brisbane, a lot of people were saying, why did you buy in Brisbane at that point in time? I think just looking at purely from a cycle and a numbers perspective, it had the mother of all booms in 2008, 2009. And then had the GFC and also the flood, and then prices came off like a cliff. And at that time, you were still buying properties cheaper than what they were selling for in 2009. Like I remember picking up a property, the previous owner paid $340 for it. It was a 4-bedroom, double-story home, and I got it for $270, and it was renting for $380.
Some people are hurting, James?
Yeah.
Yeah.
The thing with property investment is that, you obviously make your money when you buy the property. And a lot of times a good investor is capitalising on other people's misfortune. And as bad as that sounds, it's a reality of securing the right properties. People
right.
who are, it's mortgagee in possession, or there's a deceased estate, or, people need to move stuff quickly, or there's been a divorce, or anyway, smart investors buy stuff typically off people who are a bit distressed, and there's implication stuff for that, but it's the reality of the situation.
That's
You
right.
bought that place a lot cheaper than some the previous owner paid for it.
Yeah, and
you're the winner, they're the loser.
Yeah, and unfortunately that's the case in property investing, and property investing can be very dangerous. It's not everyone wins in it. So, and the thing that I keep telling my guys around it is just make sure that you hold for a cycle. Because if you buy, say, at the wrong time and then you exit at the wrong time, you can do very, very badly in property investing.
Okay, so you go on Sydney, then satellite towns,
Yep.
Newcastle,
Yep.
Upton and Bucketheads.
Bucketheads, yep.
Go on, that didn't work too well.
Yeah, that's right.
Up in Brizzy.
So you gradually started making your way north.
Yeah, exactly. Yeah.
So you got a few in Brizzy in 2014. Then what's been the most recent stuff that you've bought?
It's all been in Brisbane.
Okay.
And really, I mean, Brisbane, it's not because I'm tied to Brisbane in any way. And I guess one of the questions as an investor that I get the most is where should I be buying, or what's a good hotspot to buy? And I guess my answer to that is pretty generic. I don't really mind where I buy for two criterias. One, it cash flows. So just make sure that the rental payment goes to pay a big portion of the mortgage or your expenses. At least make sure, you're close to breaking even. So even if you, touch wood, lose your income, that you don't lose that portfolio. Because unfortunately, that's how a lot of people get unstuck in property investing. They've leveraged too hard. Their income gets cut in some certain way and they're forced to sell those properties. And if it's at the wrong time, those people can be hurt very badly. So one thing is make sure your property cash flows. And two, now looking back at my own portfolio, what's done well and what hasn't done well, is just buy as close as you can to kind of like a CBD or capital city. If you can be within, and every capital city is different. In Sydney, some people are investing out in Penrith and they've done pretty well with it. But in Brisbane, the city is obviously a lot smaller. So if you just buy generally closer to a CBD, over the long term, over one cycle, you generally do well.
It's just the fundamentals.
That's right.
There needs to be demand for people to live there and therefore rent there. It needs to be close to transport, amenities, schools, hospitals, etc., etc.
Exactly.
You're not reinventing the wheel in
No.
terms of understanding what makes a good purchase. It's interesting. I get asked all the time. I go, Phil, what's your strategy? What's your property investment strategy? And there's lots of different strategies that people can follow. One is to buy off-the-plan apartments. Mine, we identify under market value properties in affordable areas with high demand for rents. Stuff that we can manufacture equity in, i.e. do a renovation, or because we've bought it under market value, there's good equity in already, and it's as close as possible to being neutral or positively geared. And if I can't achieve, and sort of lower price range stuff, if I can't achieve that in Sydney, I'll go to Brisbane, and we've been buying up in Brisbane recently. Last place we bought was down in Wollongong, where we see these same indicators, which allows us to follow this same strategy. So it doesn't matter where it is, it's still the same idea, same purpose, and we'll just go to where the properties are. Right now, you've gone through a number of different styles of property investment, it looks like. The first stuff you did, and I'm giving you a hard time about your off-plan apartment, that's gone up in $20,000 in 10 years or whatever. But, you started down my particular path and going, yeah, it's not right. Let me reevaluate, reassess what's next. And then your next placement, Macquarie Park, was much better. It was an established dwelling. There was no bells and shiny bells and whistles. I imagine the strata was a lot less on it, all this type of stuff. And it sort of got you going down a path of reflection and reassessing what you wanted to do as a property investor. And it sounds like the stuff that you've picked up since you've gone through that renovation stage. You spent a fair bit of money on your renos. I don't know if you feel like you've overcapitalised those at all.
Yeah, I would say in the early days, I definitely did overcapitalize a little bit. Probably the first one that I did.
Yeah.
You get a little bit emotional. People say, don't get emotional over properties. Sometimes it's hard.
It's hard not to.
Yeah.
It's hard not to. You think, I'll just do that. It'll look really good. And it doesn't add anything to your rental. I guess the point I'm making is, what's your strategy right now? What if I said, what's your property investment strategy?
And I would say it evolves. And for me, I would say two things. The first thing that I say, and I get asked this quite a bit, is as a property investor, view yourself as a problem solver. So the more problems that you solve, the more that you'll stand to gain from the property. So I'll give you some examples. Let's say, for instance, that off-the-plan property that I bought, did I solve any problems? Absolutely not. When I bought it, it was brand new and shiny. The developer and the builder solved all the problems for me. I walked in with a finished product. So it stands that the property and the developer and the builder would make the gains from that property. Now moving down the track in terms of properties that I've done well in, there's been problems in terms of holes in the wall, bad carpet, bad paint, kitchen, bathrooms. I've gone in and solved that problem, and then you stand to gain from it. And things like splitter blocks, putting on duplexes, you're solving a problem. those are bigger problems. So the bigger the problem you solve, the more that you stand to gain from it.
But the greater the risk as well.
Exactly, yeah. So I guess it all depends on your level of confidence and also on your experience. But as a property investor, just look for problems, because if you can solve those problems, then you'll generally do well.
And that's pretty much, James, you guys write about this a lot. It's about your appetite or your inclination or capacity to actually be a problem solver. A lot of people don't want to solve problems. They just want something going, bang, here it is, give me a yield. And, we see investors big and small, and
yeah, for sure. And I think it's a good point that Michael makes about being a problem solver. It's a great way to think about going into.
I think it's a great analogy.
Great analogy about going into property investment. Obviously, people have different risk profiles, and I think that's really important. I think that's why it's important for anyone, when they're going into this sort of career path, as it were, you know what I mean, or strategy of investing in property, to have a good team around them, because regardless of their ambition, their talent and their aptitude will obviously, need some work, and, you learn from experience and that sort of stuff. I reckon having a good team of professionals around you, whether it's a mortgage broker or accountant, is probably the most important thing.
It's good. So let's do a hypothetical. I'm going to give you $40,000, and that's a deposit or your other incidentals associated with buying a property, so stamp duty, legals, all this sort of stuff. Where would you buy?
Well, I'll answer that in terms of this week. I actually had a property settle.
Okay.
So it was in Woodridge.
Yeah, Woodridge, great spot.
Yeah.
I've got a place in Woodridge.
Okay, great.
Absolutely. They're killing it there.
I mean, Woodridge, it gets beat up in the news a lot.
Yeah.
Is it an area that you want to live? Probably, touch wood, probably not. But fundamentally, it has a lot of things going for it. The suburbs that are on top of it, you've got Underwood and Springwood, and they're, all median prices over 500,000. It's only 20 Ks away from Brisbane CBD. So fundamentally, it's good. I picked up a 2-bedroom fixer-upper for 220,000. So at the moment, we're going through the renovation. We'll probably put in about 20,000 into that, and then we'll just get it rented out. So, rent at the end of it, probably looking at about 280 to 290. And we're just going to hold on to it. That was essentially just a land value purchase, the land itself. The other thing that I'll look at in terms of value is anytime you're buying an investment, look at how much the vacant blocks of land that are selling for in that area. And it's another reason why there's quite a few investors buying, south of Brisbane, north of Brisbane at the moment, because vacant blocks of land will go for around about the 200,000 mark. So I know even the house that I bought, it's in terrible condition, but I can't build that house for 20,000.
Another sort of what if. Yep. I've just opened the door to the Smart Property Investment Show Time Machine.
Yep.
And you've gone back to 2004 when you were a 21-year-old poker player. Other than telling yourself, don't buy that off the Planet Studio, what would be the one gem of information that you say, Michael, mate, this is Michael from the future, do this?
I would say just become a problem solver. At that time, if I had my time again, of course, you will look back and then go by areas that people weren't touching at that time. Even back then, I know Blacktown, no one wanted to touch Blacktown. My own parents ran a supermarket around Rooty Hill, and I remember working on the cash registers there. And it's like, you probably wouldn't want to buy in that area.
If you bought in Rooty Hill back then, you would have absolutely...
Yeah, you would have absolutely made a killing. Yeah. I still remember walking past, the real estate agents. You could pick up properties in the 250s, 300s, no problem at all. If I had my time again, probably would have bought something, a bank mortgagee, fixer-upper, done a bit of work to it, and then just sat on it, and you would have done very well. And, I can see similar things unfolding in the Brisbane market at the moment. I'm not saying that it's going to unfold to the same degree, because I think Sydney and Brisbane are very different. The population isn't quite there. But, there are still some similarities between the two. So I'm just trying to replicate what was back then, now in Brisbane. Unfortunately, the numbers don't quite work in those areas anymore. You can't get your 6 to 7% yields that you can get up in Brisbane. So just move with the times.
Michael, really appreciate it, mate. That's great. Let's get you back in again. You just settled on the property in Woodridge, but let's touch base in 6 months' time and see where you're going. Best of luck with the new business. What's your mortgage brokering business called?
It's called Mortgage Channel.
Okay, you can just, so if someone Google it, they'll find you.
Yeah, so they can go mortgagechannel.com.au. They'll be able to find me.
Nice one. Good one. James?
Yeah, good to be here. I think we'll have to get Michael in once he's reached that $1 million a year in passive income.
Yeah, probably coming with his Zimmer frame.
Yeah.
It's good.
That's it.
Thanks for tuning in, everyone. Check us out, smartpropertyinvestment.com.au. We're also on all the social channels if you want to know what we're up to. You can follow me at Philip Tarrant at Twitter. You got a Twitter as well?
I do, but I don't know what it is.
Okay, there we go. It's the modern age, and you're a lot younger than me, mate. Remember to keep those reviews coming on iTunes. We really appreciate your input, guys. Also, feel free to contact me, Philip, and the address is editor@smartpropertyinvestment.com.au. Send me through your questions. Is there anything you want to ask me or James or any other regular guests? We're happy to answer those, or we can get someone in to answer them for you. So thanks again for tuning in, and we'll see you next week. Bye-bye.